Hey listeners, it's Paul Andriola here. Why not join our community at Small Cap Discoveries, where we offer our members direct access to some of the best microcap investment opportunities available. Our members are getting access to premium microcap financings, research reports, and direct access to management. Sign up today at www.smallcapdiscoveries.com.
Hi, everyone. Welcome to the Small Cap Discoveries conference call. Today is December 2nd, 2025, and this is our first call of the new year. Today on our call, we have the CEO, Gordon Reykdal from Everyday People Financial. Everyday People Financial trades on the TSX Venture Exchange under the symbol EPF, and it also trades on the OTC under EPF-CF. The company is currently trading at 62 cents with about 119 million shares outstanding, or about a $74 million market cap. I'd now like to hand it over to Paul Andriola.
Hey, thanks a lot, Trevor. Happy New Year to everyone that's joined us today. Gord, thanks for joining us. We're starting off the new year right by getting a brand new company on board. And to let you know, I became a shareholder today, so there's a lot of firsts for on a number of fronts here. But Everyday People Financial, Trevor and I had an opportunity to speak to you several weeks ago, and we're really fascinated by what you guys are doing. Certainly fascinated by your background and the opportunity in front of you and all these things. So happy to have you on board and looking forward to learning a lot more about the business.
Fantastic. My pleasure, and Happy New Year to everyone as well. So just a little bit, I'll start with a little bit of background first to myself. I founded Go Easy back in the late 80s. That was my first public company. And I've been involved in a lot of other successful public companies as well. During my turn as basically a CEO and founder of companies, and really started developing EP Financial. We really started our first operation back in our property business in 14, and then started building it, and with the view of creating some significant shareholder value. And as you can just see by a little bit of the graph here, what we've been doing. And we went back from 21, but for the 9 months we did 48.3, but based on just annualizing those numbers, we'll be, for taking Q4 into account, we're on track to be hitting a $65 million revenue number overall. And the company overall, it has basically been, achieving, call it around a 21% or thereabouts EBITDA margin contribution overall. So we continue to see that grow. And with respect to the highlights of the business, we really have two pillars in the company overall. I want to describe each of them. And if I can flip you to the next page, that would be great. So the first is revenue cycle management. And the revenue cycle management is comprised of collection agencies, predominantly in the UK, although we have 2 agencies in Canada. And the reason we've renamed it revenue cycle management is that it's a very different platform than what you would typically understand in the collection business. These are all based on affordability. So this is something that we cut our teeth with the Financial Conduct Authority in the UK, is that having customers' payments spread out over a long period of time that we actually collect on that are based on their affordability. So what that's done is built us an enormous long-term book of accounts with commitments for people to pay. And right now, with our oldest company in the UK, we have north of £100 million in commitments, basically arrangement book, with a 92% success rate. So we just collect receivables on behalf of blue chip companies. We do a great job at it. We do plan to continue to consolidate in this industry. We've completed 4 acquisitions over the past couple of years. We do have our sights on a couple of other acquisitions for 2025 and onward. And just to give an understanding on where we're going with this business overall, we put a press release out on December the 10th that describes where we're going with the company, because part of our strategy with the acquisitions is not only to acquire the companies and then fully integrate them, but then also add to the portfolio, which adds to our margin, our bottom line, and profitability. So we put a press release out that we increased our client base by 70%. And just to connect the dots on that, Our annualized run rate on Q3 for this business was $50 million a year in revenue. So we basically, what we're telling the market is that 70% increase will be realized upon in 2025, and not at the beginning of the year, but probably midterm. 70% of our growth are adding 35 million to that revenue stream. So without doing any further acquisitions, we in hand have basically approximately an $85 million revenue stream with about a 20% contribution margin to that. So which is quite exciting for us overall and a great accomplishment. And we started this business, this part of the business, the revenue going back in 2020. In 2021 was actually $14 million and much less in 2021. So the numbers are quite good what we're adding to this. The other key thing is that we have significant growth potential. We actually, on our acquisitions, they're all self-funded. So when I'm being self-funded, basically, whatever cash we're borrowing to purchase the business is going to be bank financed at bank rates. And then we have an earnout formula and then an equity component to make up the full purchase price. Our last acquisition that we completed in November, we issued the equity at $1 per share. So the sellers of the company obviously seen the upside of where we're going as a company as a whole. So we didn't dilute the company, but it's all, again, self-funded with respect to what that revenue produces for that business. It produces excess cash flow and helps contribute to the overall contribution for this division or this pillar in the company. So we see some pretty exciting things here overall, and we'll grow this. We hope to add 1 to 2 acquisitions in 2025, which will help move those numbers upward and hopefully push our trajectory of numbers edging towards an exit of closer to 100 million revenue off of this one particular pillar. The second pillar, if you just flip the slide, Paul, be great. So this is on the financial services side of it, which is our other second main pillar that we put a press release out today on. So we have multiple products that we have under the financial services side, which is distinctly different than the revenue cycle management business, but certainly adds for a broad diversification in our overall portfolio as a company in helping generate income from different income streams. But this is at a much higher and more attractive margin. As I mentioned, RCM, we're around a 20% margin. The margins on this particular pillar in the company are between 75 and 90%. And some of the programs that we have under the financial pillar side of it are basically Everyday HSA, and that's basically a healthcare spending card that allows for employees to actually make their healthcare spending purchases without coming out of pocket and waiting to get reimbursed. So we've completely developed that platform within our in our portfolio, in addition to our EP, Everyday Wallet, to help basically on mainly predominantly in government programs. For example, we're discussing with the province of Alberta moving and shifting. What they do right now is they provide anyone with assistance with either checks or direct deposits that we're actually replacing for a card that eliminates any, misuse for the card, but also provides flexibility to be able to provide it on a card versus doing through a check or through a bank account that the government has no actually visibility on where that money is being spent. So some of the unique programs that we've, products that we have basically on the HSA and the Everyday Wallet are streamlined so that the card cannot be utilized at like a gas station or a ATM. They're strictly used where they're designed to be actually achieved. So those are very, very high margin products for us. We've already put the development into them, and now we're starting to roll those programs out in 2025. And the others, for example, under here are the EP Board Down Payment Program. This is where we actually help consumers that are struggling with coming up with a down payment. We actually work to provide them that down payment, but we work through a builder's program and network that we have established that we essentially get a rebate back from the builder for bringing them a new qualified buyer. So essentially, we're basically on lending the money we receive from the home builder at that point. So a very good program that can drive a lot of income to our company as well. And then supply chain, we help companies overall with the overall improvement, enhancement with supply chain, and actually their productivity and movement and sharing the profits in that. But to put things into context of what this really means, so last quarter, and I can point to our probably our September numbers, we generated $1.498 million in revenue for the EP Financial Services. Our total costs were $144,000, which generated a margin of 90% return for us. So the $1.4 million annualized will give us about a $6 million contribution on a trailing basis. Our objective is to actually try to work those numbers upward, and from a standpoint of moving that a much higher number. There's a probability of increasing that probably double to where we're at in 2025 with the execution of these programs. So we see that that will be a significant contributor to our overall profitability and our EBITDA contribution in 2025 and onward. So those are some of the key facts that we have that basically help guide towards where we're going as a company. So we've got really two main revenue streams, two different margins, two different levels of scalability. But we've structured in the basis that the company minimizes any capital. We don't need to raise any capital to build any of these products or acquire companies. We're doing it on the RCM side of it with equity at a value that we've deemed to be the proper value for the company that is accepted by our sellers. And then on the EP Financial Services, we require zero capital to grow this and scale the size of the business. And we just also announced the renewal of our banking arrangement with DC Bank. We're a program manager, so we design these programs that are all MasterCard and Visa approved programs that we're going to be rolling out in 2025 onward. So that gives a pretty good idea of where we're at as a company. And for 2025, if we can achieve the same revenue growth that we did in 2024 over 2023, we should be pushing close to that $100 million mark before any acquisitions occur during the year. So we're moving along quite nicely as a company overall and well positioned to drive and increase shareholder value significantly over the next several years.
Perfect. Well, Gord, thank you for that. I want to remind everybody that's listening, as always, if you've got a question you'd like me to ask Gord, please use the chat function and we can take care of that. I will stop sharing my screen here. And there we go. Okay, fantastic, Gord. A couple different divisions of the business right now. Maybe can you try to give us a sense? I mean, financial markets are huge and
Yep.
there's a lot of sort of addressable markets, but maybe give us a better idea of specific to you, the categories you're talking about here. What kind of addressable market do you have in the different geographies you operate?
Okay, so with our UK operations, and I'll focus more on the revenue cycle management business. So I'll start with that one first. So revenue cycle management, as I mentioned, the structure that we have is very, very unique, where everything is based on affordability. That's now part of regulations that we plan to bring to Canada. We do believe that we can achieve numbers upward of 250 million pounds, close to $500 million in revenue under that segment with respect to businesses that are there right now without further expanding into Canada. So the market is very large. Unfortunately, in today's environment, people are having more difficulty in paying their bills and going through difficult times. But we are now no longer the scary collection agency. There's no such thing like that in the UK anymore. We're there to help people, which is good. So the market's very large and it's growing. We're very bullish on it. It's expanding. So to see us get revenues up to that $500 million level mark, over the next 5 years, that's within our grasp. And the market that's only a fraction of what market is available for us. That's what we've sort of put our sights on. With respect to the financial services side of it, the total addressable market is massive. And this is really what we're doing here is we're targeting to the largest group of employed Canadians, basically, in the marketplace. And we can take this product elsewhere, but we'll focus on Canada first. So when you take, for example, I'll go into home ownership, for example, I'll start with one program. By us providing this program, this is a big opportunity for us. So when I say we can do 300 or 400 or 500 homes, even 300, for example, that will add $9 million to our bottom line because we make about $30,000 a profit per transaction. So that's a very, very large number. And 300 homes is not a large number in Canada for people that are looking for down payments. But if you think about the total market in Canada, and we'll focus there first, it's massive. So we don't need to take a big chunk of the market. The market's much larger than that, of course. It's multi-billions of dollars that are people that are buying homes. But there's a certain portion that have the good quality credit, but just can't come up with a down payment. So we've actually got a good program in place, and we've already put loans through that have been CMHC approved by lenders and banks, so which is good. So we're now just starting to roll that out. So the market's very large there. So you can use the numbers as you wish, but we've got our sites that's some pretty good numbers on that. And then when you go to the HSA, the healthcare spending account, there would be in excess of 9 million employees in Canada that have healthcare spending accounts. So our program is what we do there is the first thing is that from a value proposition is that from a consumer's end of it, that now eliminates the concern of saying, okay, if I have to buy a set of eyewear for $500, I haven't got the money to come out of pocket, they can't use the program. Under our program, they can use it. And the beauty of it from our end of it, so there's no cost to the employee, and the employer cost is cut off probably anywhere up to a third of what they would be paying right now for some other company to administer their program. So we've kept the cost down for the employer where they can actually administer the program at a much lower cost. That means better benefits for their employees, and the employees are able to use this seamlessly without any reimbursement or waiting for money to come back on their card. So that is a very, very large market, and we make on average estimated $60 per card per year is what we make off that. So the numbers are very large. You start adding up. 10,000 cards is $600,000. So you can just do the numbers. So we've got a large market, but we're starting the process with a very unique bespoke program. And then you get to on the government programs, what are there? Like in Alberta, there's about 150,000 individuals that are recipients of some form of support. And this could be, it could be from any sort that they've applied for, that they've qualified for, that we can provide everything for in a card that provides not only the proper accounting for any government agency, but also where it can be used and cannot be used. That is a very large market. When you look at Canada as a whole, if you take Alberta, say, for example, is 4 million of the total population, say if it's even 40 in Canada, so we're 10% of that population, you've got a very broad market of people that could use this service in Canada alone. So it's upwards of 1.5 million across the country. So very large opportunity to do that. And we make our money not off the government because it's done free for the government. We don't charge them a penny for it. We don't charge a penny to the consumer. It's made off the interchange from the Visa because it's on a Visa platform. So we would make 1% basically of that. So I'll use an example. If someone was getting $15,000 a year, we'd make $150 per card per annum off that as it's utilized. But again, and no cost to us, so we don't put up any of the capital. The other areas where we are, and we currently are providing services for on the financial services side of it are along the same lines. They're all high margin, all high opportunity. But really what we've targeted here, to be frank with you, is the broadest market that is available that's looking for services that can be provided for at little to no cost, but it's actually providing them access. And that's really part of what we're trying to accomplish and what we've designed here. So in my background being in consumer finance and credit, well, we're not a lender. We don't need to be a lender. So let's, instead of going after a very small finite market, go after the masses. And this is the masses. So this is the largest basically market opportunity that exists, whether you're going from homeowners to employment to people that are looking for assistance to people that are actually have run into difficulties that we're collecting upon, that we put together programs that make it less offensive. So you look at the basis of the whole thing, we're covering it from both sides that really provide the broadest and best service available out in the marketplace. That's really what our whole company's about, to be quite frank with you.
Mm-hmm. Fantastic. So you mentioned a couple things earlier about the M&A programs that you have in place. Or self-financing. And it sounds like, obviously you guys are profitable now, but Do you need more capital for what you're trying to do? Is there any other initiatives that are going to require capital?
Yeah, so what we're doing, for example, and the answer would be it'll depend. So what we're doing right now, like the last acquisition, we did at $1 per share. So when we look at the RCM business alone, I mean those are valued anywhere from 3 to 3.5 times annualized revenue. So if you take our annualized revenue just basically on Q3, we're at $50 million on the RCM side alone. So getting a value that there is important. So the markets, which is all fine, understandable, the market's not where we see it as from a valuation goes. But if the market, starts catching up to where we think the value is close, but everybody's got to make money, we understand that. We may go to the markets instead of having the sellers take the stock. We may say, okay, look at now it's time to put it in the market's hands, and we'll do an equity issue, but as long as the value's right. But we certainly wouldn't be even thinking about these levels. I mean, and for future acquisitions in 2025, we'll be moving that number upward well over $1 because we just announced that we're adding 70% to our customer base. So, we know we're going to be there without anything happening, just continue to execute. That value will be up there. So it would have to be dependent upon that share price being at the right price. Otherwise, we will just continue doing what we're doing. And, the sellers are happy because they're going to pick up a good gain on the value. It's a longer term deal for them. We've got them into earnouts over 2 to 3 years. So it'll just depend, so we don't need any capital otherwise. And the acquisitions, we don't buy them unless they're 100% self-funding and spin off excess cash flow. So we won't buy them otherwise.
So it's safe to say, I mean, you guys have used $1 as that sort of price to make these acquisitions. So my assumption from what you just said is like if the stocks are trading at above $1, you'd consider it. But until then, you're looking at $1 at least as being fair value in these transactions.
Yeah, no, and no, that's exactly right. And that, and we've advanced things like the reason why we put the press release out on December the 10th is that we secured more contracts on the RCM side of it, which were very material to the company overall. I mean, they were a month prior. We've been working on them for like a long period of time. But so we'll add quite a bit on that side of it. So that number it'll be a moving target. We're certainly, as you can tell by the chart and the graph where we're growing. I mean, we've just begun, right? So to get this thing really going, we'll continue to drive the value. But again, we know that everybody's got to make money, so we're not going to be able to sell equity at where we think the value will be at. We're a new company. We're just getting going. We want to uplist the company to TSX in 2023. We plan to do that. We think that could have a positive impact on things as well. So, but we'll just play it by ear. But the key thing is I like to deal with the things that within our control. That one's within my control, which is good. So I love that. And and we've got 2 co-CEOs that basically run the business. They're masters at their business. They deliver results. They've got long-term proven track records. So they do that, and I'll take care of this side of it. So
Very good, very good. Okay, well, you mentioned co-CEOs. You mentioned your background a little bit, the Go Easy. Maybe let's talk a little bit about the rest of your team. What can you tell us about?
Yeah. So Graham Rankin. So Graham Rankin, he is the co-CEO of Revenue Cycle Management. He's a co-founder in EP. So my family owned the collection business that he founded in the UK, going back since 2014 or thereabouts. And but he's got a 20+ year experience in the debt collection business and is a real seasoned veteran with respect to that, and is highly regarded and very high credibility within the industry from a regulatory perspective, but also knows and understands the business and knows how to scale it, knows how to build it. So really, really solid. And then Barrett Reykdal, who is my son, who's also a co-founder. He's got 20+ years experience. He worked with me going back in the day in Go Easy. And then basically our next company was that we built and started Castro Financial. He was the chief operating officer for 500 some odd locations in Canada and in the UK as well. So really deep operational experience as well. And then we have other individuals. We have two chief operating officers, both in the UK and in Canada. Chief strategy officer. We got a technology officer, compliance officer, senior VP of finance. People that have been with me for 20 plus years type of thing. So these are all long-term people that have been around in business, different ventures of mine. So
fantastic. Okay, so another thing that I found intriguing is insider ownership. Maybe tell us a little bit about the level of insider ownership, and maybe even sort of the composition of the rest of the shareholder base.
Okay, so as I've done before with my other companies, I started these basically with friends and family, but putting up a large portion of my own capital to get it going. So my family would have north of $21 million of capital put in the company with debt and equity. And then the composition of the other shareholders, especially at the outset, are basically people that have been with me for several of my prior ventures, Go Easy, etc., Castor and Carfinco as well. And so although the insiders right now would own about 30, a little bit better than 35 or thereabouts percent, it's predominantly made up by myself. And then there's other close friends that are long-term shareholders that would make up a minimum of another 30% that I would consider long-term folks that would be there. So it's a fairly tightly held company. I sort of still view it as a privately held public company at this stage. But as we continue to develop, I mean, things will change obviously. But so a lot of the stock is very with long-term people that basically have either been with the company or and/or stock that my family owns. It's pretty significant. So we put our money where our mouth is, bottom line. And I didn't want to get out, start talking about the company till I wanted to get 4, straight consecutive quarters of good, solid performance under our belt. And now we're going to quarter 5 and going forward. So I've got a lot of confidence with respect to the shareholders that I've known for a long period of time. They know what I'm doing. So
yeah. And you eat your own cooking. That's clearly what we're seeing here.
Absolutely. Yeah. No, I put my money first and then make it work, and then we go start talking about it. So
I love that. How about institutional ownership? Are you aware of any institutions that own the stock?
There's not right now, and this is part of what we want to do. With our TSX listing is institutional ownership. Also push to get some research on the company, because the company, I'd probably describe more now than anybody knows on the company. I mean, it's all there and people can read it, but really this is the first time getting out and talking about the company. So I think there's opportunities there to get institutions involved, and but I think we'll be better suited or fitted when we get TSX listed. So I believe that'll help a lot too. So.
Yeah, we certainly appreciate it when you come to us first and tell us before everybody else finds out about the company. So it's
it's a key. I mean, I've been around long enough to know sometimes more what not to do than some people know what to do. So, but
that
I
helps.
want to make sure that everybody's aware of what's going on, and everybody can make properly informed decisions is really the key. And part of my job is to ensure that I communicate and make sure that all the information's there, but also my accessibility. I'm always very and fully accessible also too, to meet or talk. So, which is important in any company. Communication's key.
Now, let's go back a little bit, back to the M&A side of the business again. Maybe give us a sense of maybe you can talk to the pipeline of M&A opportunities, but maybe the landscape. Like what typically does a business look like that you're buying?
Yeah. So some of the, and this is really where our target and our focus is there are long-term established businesses that have a significant track record and history of financial performance and operations. So, because we're only acquiring in the revenue cycle management business, and so some of the companies that we purchased date back to 1988 in operations. So these are companies that predominantly right now we're focusing on the UK market for acquisitions. So long-term, good solid track record, good solid performance, good credibility in the marketplace with regulators. And founders are looking for an exit that basically, but also want some upside going forward in our company. So the way we design the deal, we'll buy a company, it could range anywhere from 5.5 times their trailing EBITDA numbers. And then what we do is we pay 55 to 60% of that would be cash on closing. Then basically we would have the balance either 20-25% in equity, which the last deal was 27% equity at $1 per share, and then the balance on an earnout to keep everybody honest, to make sure that we bought that the earnout is there. So we tie another portion to that over a 2 to 3 year period that they're paid out over that time frame. So that would be the typical structure and outline of an acquisition. And then what we do from our standpoint internally, we ensure that that the company can cover its own debt servicing, principal and interest payments, plus leave a surplus. And then going forward, the business itself, as we continue to develop it, it will only increase the value of our company overall. So we'll be able to move that share price up. And from a standpoint, the market right now, we've got a couple of acquisitions that are underway right now that we're looking at. That could add another 10 million plus per year per acquisition in 2025, or not maybe the full year, but at some point when they're acquired during the year. We're confident we'll close on some acquisitions. So they're usually some pretty significant contributors overall to the company. And we think, the market's quite depth. We've got about 10 companies in our total pipeline. And if we can do 2 per year, we'd be happy with that, depending on the size. If they're smaller, we'll do more, but we can handle 2 per year quite comfortably. And then part of the integration is, so once we acquire the companies, they may be at margin X, is then when we acquire them, we bring them under our infrastructure. Obviously, there's going to be some, be able to realize on some costs and synergies and eliminate any duplications in the organizations. That's sort of our first step, and improve overall performance, which usually has a good improvement in the basically acquired EBITDA number. So we move that maybe from initially from say a 5 or 5.5 down to say 2.5 or 3 after we fully integrate the business. So these are important things. So they're very well structured, which is key, because if in my view, if we can't self-fund them, we're overpaying for it, is really my view. Mm-hmm. Because we want to make sure that they're all day one accretive to the company. Like, that's important overall. Otherwise, we won't buy them. I mean, we'll continue to layer on. The market's growing because we'll have X amount percentage of internal growth, and then we'll have acquisition growth. So we know that we can do that and build under that structure. So they've all got to make sense to us. And so the typical company we're acquiring are people that basically that are founders of the companies that are looking for an exit, that still want some type of trading value there. That's really our target. To be quite frank with you, even the last acquisition, selling them at $1 per share, that was the easiest part of the negotiations of the acquisition, because they say, okay, we're getting our earnout in year 2 and year 3. Well, great, we understand what the value will be. Well, they're going to get a further lift in their view based on that, because we're not going to stop. And I think I've got a good track record with respect to growing and creating shareholder value. And we've just begun now. We just really got our footing, so we'll continue to do that. And it should represent some, in my view, some pretty significant value accretion over time. And there's the people we're buying from. They're the easiest to understand that, because they're in the business. They understand it. So I don't have to sell them too much on that part of it.
That's perfect. That's perfect. Okay, listen, we've got a whole bunch of questions that have come in, so I'm gonna start slowly asking some of these. We've got Bruce, who asks, when was the last time you raised money in the market? So when was the last time you did an equity raise?
We did it at $1 per share. It was about a year and a half ago, or thereabouts. Yeah, or probably would have been just before we went public. So it'd be 2 years September. Sorry, yeah. So it was around August or so. We did $1 per share, of which also my family participated in too, as well as other insiders. They bought a big chunk of it. They bought the majority of it, basically, to be honest with you. So yeah.
Good, fantastic. How much was raised? Do you remember?
It was just a small amount. It was just more. It was like $4 or $5 million. So
4 or 5 million. Okay, yeah. Perfect. Gotcha.
But it was pre-public though.
Pre-public. Okay, I got you.
Yeah.
Okay, fair enough. Okay, we've got a question. This is a question from one of our guys in the UK. It says, in the UK, there are a considerable number of young people together with the general population who cannot get on the property ladder. It is just completely unavailable to average wage earners. How do you help these people?
So this is for home ownership.
That's what it looks like. Yep.
So we also presented to the government of Scotland. So they're in the pipe for us to start doing and getting engaged in this. So we are going to be offering this in the UK and mainly in Scotland. So we will be starting with a pilot project there with our own employees in Scotland that are basically there was something like 40 of our employees when we did our analysis that would qualify under our program that are renting right now. So our program, it has to be, has to be FCA approved, has to go through some process. We're working with a firm now and actually getting this in a position to start rolling it out, which we think there'll be significant take up on it. So we believe that we're going to have a good program that will be validated and supported under the FCA, because it will have to be blessed by them. But the bottom line is we're going to be able to achieve providing this to good. I mean, it's not going to be high wage earners, but typical people looking for first time home. There'd be maybe in the UK 150,000 pounds. But we used our staff members from a credit worthiness and cash flow perspective. They would qualify for it, so we know what works. They'll be the first ones we'll be trying to and working the program with. So we do intend to roll it out in the UK. Definitely, lots of opportunity there.
Mm-hmm.
And I can send more information as well too. But I mean, it's exciting for us. And with operations there, it's right in our backyard. Of course, we're going to do it there.
Mm-hmm. Fantastic. Okay, question from Paulo says, is the goal to be acquired by the likes of a GoEasy or Propel or others? What do you see as the end goal here?
Yeah, so the answer would be no on those, because those are both high cost lenders, a high risk market. We have nothing to do with high risk, high costs in our business. So the ultimate goal here and what we're doing and how the company is being positioned is actually to become a strong dividend paying company. So when you take into account, we don't pull on any other money from any other part of the business because the acquisitions are self-funding. Everything else spins off cash flow, free cash. They're set up to be strong dividend paying companies. So the focus is to have it as a strong dividend paying company, which will drive value on itself. We never say never to, because we don't know, it's a public company. But from a standpoint, what we're doing overall, we think we'll be attractive to a lot of companies because of the reach of really what our company is doing, and plus also our values are really what our company is all about, is completely different than the other companies. So I never say never, but but bottom line is, from a standpoint, we're just starting our journey with respect to building value. So we've got a lot to offer. We'll continue to build. Our primary focus is just get this thing dividend position paying, and then we'll continue to ratchet that up and then see what happens. Let's just go from there.
Absolutely.
Yep.
Absolutely. Yep. A lot of options here. Okay, question from David in regards to geography. What is the current percentage of revenue per geography? Canada, UK, USA. Are you looking to expand into any other areas?
Yeah, so in the UK, for example, now we just with our recent acquisition, our revenues would be roughly about now, if I just take the annualized numbers for Q3, that's roughly got us around, overall, call it $70 million or thereabouts, revenue numbers. So about 35 of that is in the UK, and then we've got about 15 in Canada, and then the financial services. Predominantly, we've got another roughly, call it 6 million in revenue off the financial services side of it, and then EP Homes before we got a little bit of revenue which is in Canada, but that'd be the bulk of it. But it's a little bit more heavy weighted in the UK, then followed by Canada because of the EP Financial Services. But we will be expanding EP Financial Services into other markets. But we want to capture what we're doing in Canada first and get that right before we do that. So, but we can see that the UK will outpace, because we're going to be continuing to acquire there. So we can see that being a little bit of a higher percentage of revenue. But then on the margin side of it, because of the margin significance of the financial services products, we can see that there'll be a significant increase and drop in the bottom line for financial services. So although the revenue cycle management will say produce a 20% number, we'll continue to grow those numbers up predominantly by the UK. And then the financial services side of it will drive a much higher number. So it'll balance itself out from an earnings perspective over time. But we're probably a year away from that actually happening where we have them, similar or close to being equal.
Okay, fair enough. Gord, where are the risks in this business right now? Where do you see the potential, things going sideways?
Yeah, so I mean, I do pride myself in my experience because I've been through a lot of risk and assess businesses accordingly with respect to that. And that's predominantly what we've tried to do in EP when we set up EP to build it, is knock all that risk down completely. So other than things that and basically have things within our control. So when I look at it from a risk perspective, you look at revenue cycle management. Well, we monitor our business there daily, hourly, daily, weekly, monthly. So we know our performance and we know that where we stand on that. So your performance really dictates your security and where you're going in your future. And the better job we do, the more business we're going to get. So we're knocking it out of the park on that side of it. So that one there, like I'd be close to saying you could set your watch to that performance because we know that business very well. And again, if I take into account the acquisition we just completed of CCS at the beginning of November, that's 60 million of our revenue total for our RCM side of it. That's a pretty predictable component of our business. So, and from a standpoint of going forward, on the financial services side of it, we've really focused on minimizing our risk, but really it's designed on the products we provided. So they're all prepaid products. Everything is basically, all the funding is coming from other sources other than ours. So it's really our innovation that we put to work on actually how we can develop programs that we can leverage off of that. It's all performance based. So that's within our control. So we have to do a good job at selling companies on the healthcare spending account, and the cost of the small, so it's going to be easy to sell in my view, and other programs. I think that we've designed this to actually minimize the risk, but I always put it back to execution. So everything really lies on us in execution, to be frank with you. So when we got that type of opportunity, your risk I really put around our company is executional based. That's really what I put it around. Because otherwise we've eliminated the factors. We're not going to take on anything that is going to, on an acquisition side, that's going to create problems with us. We're buying long-term businesses that have been around forever. We're not buying any startups that could be, risky. They've got to have a good track record. We've got them financed properly where earnouts are there, equity's there. So we can't run into a wall there. And then on the financial services side of it, it's continuing to build the business really is operational execution, of which, quite frankly, I pride ourselves in. So that's really, the risk is going to be more around the execution side of it than anything to the other one. Because there's no external factors that are out there that really could create any issues around us or for us, pardon me, that we foresee or I would consider even thinking about, other than what I've just mentioned. So.
Now, maybe slightly different question here. So we understand the risk that you just mentioned here, but what sort of keeps you up at night? Like, are you looking for staff? Is there enough M&A opportunities? What challenges does the business face out there?
Yeah. So I mean, there's always there's always challenges with respect to the business to ensure that you're hitting your objectives. We don't set light goals internally with respect to what we want to achieve. So we ensure that everybody's working to ensure that we're striving to do good. So it's pushing. We're pushing. We're not taking everything waiting for it to fall in our lap. That's not the way we operate. So there's always that, but that's more on the operational side of it for both for Graham and for Barrett, and they monitor that again, hourly, weekly, daily, monthly onwards. So. With respect to, from my perspective overall, my end of it is more, my focus is really, helping develop, most of these products I helped develop at the beginning. Those were things that were there that really I put my knowledge and expertise to. Now it's in their court to execute upon that. So it's more from my standpoint of actually driving the overall business itself would be more innovative. We don't need any ideas of what we're doing. It's execution, what we have. It's just basically helping drive that, value overall. So there's nothing really that keeps me up at wake saying, well, geez, this is a concern. It's more, okay, how are we doing on the operational side of it and executing and going forward? That's probably the only thing that would, the big thing from my end of it. But, I've already passed that stage where it's like, holy shit, what could go wrong here? That was a few careers ago. So a few companies ago. That's like, when I was in the high risk business, that was always of concern. But that's why we want to get into the low risk business. So, we can now drive business without having concerns of getting blindsided by something, So that's true, it's just it, So
yeah, you sleep better at night.
And I do that.
Awesome. Okay, so we're investors, and I'm going to ask for advice here. What do you think what should investors pay the most attention to? Like, what kind of metrics or maybe catalysts ahead do you think warrants investor attention?
Yeah. So I think on like the two main core businesses, revenue cycle management. Like as I mentioned, our Q3 numbers, annualize those are at $50 million. We know what the margin is. We're looking at a 20, and that's basically, we're right around the 20% margin on that business side of it. And then moving forward on driving that number going forward will be important. And we'll provide highlighted information to ensure that people have an understanding on that. And that was where the reason why we put the press release out about showing that 70% increase. It's just to point investors say, okay, well, what happens if they don't acquire any more companies? Okay, that's a good question. Well, okay, if we don't, we've got 70% growth built into what we have today. That's a pretty good number. So you go from 50 to 85. And will it happen day one, 2025? No. But could it happen by mid-year, that run rate? Probably. That's a pretty good number. And if you take a 20%, you're at a $17 million EBITDA number. Now, that's nothing shabby about that. Like, that's pretty good. And then the financial services side of it, to keep the eye on the number on the revenue side of it, because the bottom line will flow there. We put in the press release that we put out today a 75 to 90% margin. Based on our Q3 release, we were at that 90% margin. We were at the high end of that. Good. We got the numbers are right there. I mean, and it's in note 20 of our financial statements. It describes financial services revenue of $1498, $190, financial costs $144, $322. Mm-hmm. Pretty impressive numbers. So the key is actually to monitor actually how we're growing that and building that number, because that will be key. And then we're starting the process. I mean, it's not going to be a complete light switch, but it's going to start to build. We'll start adding to it. So as we start adding to it quarter over quarter, our margins as a company overall will increase quite nicely. And that's really what's going to drive that value for us longer term. And then eventually, I think, and I don't know when, but the values will probably catch up at some point or come close to where we're at. But because right now we've got such a large spread, I must say I've got the luxury of actually promoting our company when it's so, in my view, so undervalued. This is like a dream, because people are out there talking about companies that, geez, they may be at their close to their value peak, and you're trying to promote the company. That's a tough sell. For me, this is an easy sell. So as we go on to continue to build and develop, the key things will be on the revenue side of it, because we monitor the business, we know the margins. So the revenue numbers on both business fronts are the key to be monitoring going forward. And then we will ensure that we provide adequate information to keep shareholders up to date. We will start conference calls starting in our year end and then Q1 results 2025. So we'll be able to address this. We're not at a stage where we can start talking about numbers of cards yet, but we certainly can get to that stage. So the metrics on all of all that will be very, very important. But you just got to keep in mind that any dollar you bring in, we're going to bring on the RCM side 20% home, and then on the EP financial services side of it, anywhere from 75 to 90% is coming home. Those are big numbers, but it's growing. So that's where execution is the key. But that's again, consider our strong points. So investors just have to, I want to make sure they understand what we're doing first of all, and then they can follow it. And we're confident where we're going and where we're taking the company. We've got the team to do it. We've got a very an excellent team and pool of talented executives in the company, as well as individuals that are really doing the results on the collection side of it and driving it. Other than that, we've got a pretty small workforce. Like, we would be 20 in total outside of the collection agency. So it's small. So we got a tight group. We've got a lot of experience, and we're here. We want to drive value. We're motivated. We own a lot of stock in the company, but we have a lot of our friends and a lot of shareholders we want to drive value for. We know it'll pay off in the future. So that's really what we're going to do.
That's wonderful. I appreciate that. Gord, just last question. It's an open-ended question. Is there anything we missed, or is there any key message you want to make sure that everybody walks away with today?
Well, I think no, I don't think you missed anything. You asked some good questions. We want to keep the market informed, but I mean, the reason we put the 4-year graph in our chart was to give people an indicator where we're going, and we're just starting. So, I'm excited about where we're going, and this is why that now I'm starting to get out in front to start talking about the company, is introduce the company early stage, so people can make at least see the company and understand it. And then go forward from there. So I think that we've got some very exciting times ahead for sure. Definitely, I'm very pleased about it.
Fantastic. Well, this has been great, Gord. We've been speaking with Gord Reykdal, CEO. Is it CEO or chairman?
Chairman.
There you go.
Executive
Exactly.
Chairman,
Everyday People Financial, symbol EPF on the venture exchange, EPFCF on the OTC. Gord, this has been great. I appreciate the time. And listen, as shareholders, we're going to continue to follow you closely and look forward to catching up in the near future.
Well, fantastic. And thank you for the opportunity here too as well. I much appreciate it.
You bet. You bet.
Thank you.
Bye for now.
Take care. Thank you. Bye-bye.